And a good day, everyone. My name is Mark Johnston, your host here at VID Conference for our next Town Hall Forum. I welcome everyone from all points of the world. I want to welcome you today. And of course, we are featuring a well-known company in our session today from our community known as Gold Royalty. To begin today, a little something extra special just ahead of our guests. We have a fantastic time-lapse video to give you a behind-the-scenes look at Gold Royalty's flagship royalty, Canadian Malartic. It's quite a sight. And right after this video, we welcome our guest speakers and hear from inside the company before we launch into our question and answer session. So please enjoy. We'll be back in one moment. Fantastic. We're so excited to have everyone joining us today. And at this point, I want to welcome two very special guests who we've met with before. Of course, David Garofalo, who is the president and CEO of Gold Royalty, and John Griffith, Chief Development Officer. Gentlemen, thank you for joining us.
Well, good morning, good afternoon, as the case may be. Thanks very much for having us on. I have to say that video brings me back. That's the fourth head frame that Agnico Eagle has built in that district along the Trans-Canada Highway in the Abitibi Greenstone Belt. Back in the 90s when I was the CFO at Agnico, we put head frames on Laurent, Lapa, and Goldex, three mines, all within about a 30-kilometer radius of the Odyssey mine, which is the underground extension of Canadian Malartic, which has been an open pit operation, Canada's largest gold mine for the last 10 years. So that's a very exciting and foundational element of our portfolio. And it comes with the recent acquisition of Abitibi and Golden Valley, the three-way merger we just completed about a week and a half ago. And I'd like to thank and welcome all the shareholders of Abitibi and Golden Valley into the GROY fold. Gold Royalty Corp received 99.9% support from the shareholders there. And I really am humbled by your confidence in us. You're entrusting your savings, your capital with us. And I can assure you that we'll use all our diligence and efforts to ensure that we get a strong rate of return on the capital you put in our trust. And what's exciting about our story is the fact that we've created scale very, very quickly. First, by bringing Ely Gold in earlier this year and Abitibi and Golden Valley, we grew from a very modest portfolio of 17 royalties to now 191 royalties within the Americas, and 6 of them in production, 7 of them in the development phase, and a large variety of royalties, a well-balanced portfolio from early stage exploration right through to production, which will deliver meaningful cash flow growth, free cash flow growth over the coming 3 to 5 years as many of those construction projects start to bear fruit. And then beyond that, big projects like Odyssey provide us another dimension of cash flow growth beyond that 5 years. So with the organic growth we have in the pipeline, with the generative platform that we now inherited from both Ely and Golden Valley, we have a very full pipeline for the foreseeable future. We have a multi-decade annuity from many of the royalties that we brought into the pipeline, namely Canadian Malartic. And as you've heard me say before, Canadian Malartic is our gold strike. It is that foundational asset like gold strike is for Franco-Nevada, that provides that underpinning, that foundational element, that cash flow for decades and decades that really helps us build a much more prolific and diversified portfolio across the Americas. And for that matter, looking elsewhere in the world as we start to further diversify our portfolio and put some of our capital to work. And we come out of that transaction, that three-way merger, with a strong balance sheet, just under $50 million in cash and marketable securities, no debt, very clean balance sheet. And as I said, with increasing cash flow, as we sit down with our board and management for our strategy session in December, we'll start to map out a process to get us to a dividend policy in due course. As we integrate these businesses, Ely, Golden Valley, and Abitibi, into our portfolio, we will be generating very strong cash flow for the foreseeable future. So talking about introducing a dividend, which I know that the shareholders of all of these companies are used to receiving, is something that's definitely top of our agenda. And we'll have more to say about that in the new year as we provide more specific guidance in our 3 to 5 year projections. And again, as underpinning that portfolio is the intellectual capital we brought in. I was just saying to Joanne and Mark as we were coming on to this call, how seamlessly Trey and Jerry from Ely and Glenn and Ian from Golden Valley and Abitibi respectively have seamlessly come into our management and already started to contribute meaningfully to our growth. They're part of our management team. In the case of Glenn and Trey, they're actually part of our board. And so it's not just about acquiring these assets. And clearly, we've more than increased our royalty portfolio tenfold, and that's meaningful. But we brought all this intellectual capital into the organization to add depth and breadth to the management skills so we can continue to grow and perpetuate this portfolio for the foreseeable future. So I'm delighted to have them on board. I'm actually honored to have people of that experience and success within our management team and board to complement what's already a very deep board and management. And what this has also done from a return standpoint is provided an immediate re-rate for shareholders. And as a result of achieving that scale, the market has embraced these mergers this year, embraced the scale that we've achieved, and it's resulted in a significant upward trajectory in our share price, which all of us have benefited because we offered shares as consideration in those mergers. And those shareholders, legacy shareholders of Ely, Golden Valley, and Abitibi have enjoyed that uplift as we integrated those companies into the organization. But we're in a very interesting point in the cycle. I think we're back into what we experienced 10 years ago, where we saw significant inflation in the mining sector. And now we're facing the prospect of significant inflation in the general economy. We've seen some very gaudy headline CPI numbers recently. And I think that will amplify the input cost inflation we're likely to experience in the mining sector. So 10 years ago, coming out of the credit crisis, we had a big lift in metal prices, both on the base and precious side. On the base side, because we were in the middle of the Chinese super cycle, and on the gold side, there was a significant amount of quantitative easing that was introduced into the system to avoid a depression. And as a result, we saw the gold price achieve at the time all-time highs of a little over $1,900 an ounce. So we were in a period of time when we had incentive prices for both base and precious metals. And so as a result, we saw a massive amount of investment into new mine development, both in the base and precious metal sector. And you would have expected with the gold price going up 140%, as you see in the top left-hand bar chart, that the gold equities would have done very well in that environment. But in reality, they did not provide the leverage that investors were looking for because of input cost inflation eroding the margins. And as a result, even as the gold price went up, the margins were squeezed, and you saw the equities significantly underperform. The mining producers, anyway, significantly underperformed the commodity. And that was a similar phenomenon on the base metal side. And so even though the gold price went up 140%, you saw the precious metal producers go up just under 70%. The streamers and royalty companies vastly outperformed because they provided insulation against cost inflation, because as a royalty company, you just get that top line exposure. So you can see that the streamers and royalty companies were up over fourfold. And so vastly outperformed the commodity. And even in the down part of the cycle, which you see in the middle part of the chart, when you saw really a nuclear winter in the metals space, both in base and precious, where gold was going down to almost $1,000 an ounce. Base metal prices were quite depressed. Copper was approaching $2 per pound. And even in that environment, in the down cycle, again, the precious metal streaming companies did a better job of preserving capital in a down market. And I think, again, even in a rising gold price environment with stable costs, which we saw last 5 or 6 years, we saw the streamers again outperform. The gold producers did much better relative to the commodity than they have done historically because they controlled their costs. But again, I think they're going to have a much more difficult time of doing that in this environment because of the underinvestment they've made in exploration and mine development. They're going to have to reinvest back into the ground to replace reserves that have depleted by 40% over that period. And they're going to have to reinvest in new mine development to replace depleting production profiles. And we've seen a lot of M&A activity to try to fill that hole, because if you're not finding it, you're going to have to buy it. But the industry as a whole will have to start to invest back in the ground. You can't just shuffle the deck chairs. You have to actually start to invest back in the ground to replace depleting reserves as an industry. And so that's what I think will drive inflation. And I think you'll see the streaming and royalty companies that do extremely well as the gold price goes up in reaction to the inflation. But I think the producers are again poised to underperform as their input costs start to inflate. So let's talk a little bit about the re-rate. I talked about what the re-rate meant for our shareholders, and this is a way to quantify that in very strong empirical terms. And what this shows you is that at the time we announced the merger with Abitibi and Golden Valley back on September 3rd, if you added up the market caps of the companies prior to the announcement, we should have been a company of about $544 million in size just by adding A plus B, and that equals C, $544 million. And since that announcement, the sector's been by and large flat. It hasn't really moved up or down. It's up slightly. If you look at the GDXJ, up about 2%. So that suggests that if we had performed in line with our peers, would effectively been a $550 million market cap company. In other words, just adding the two market caps together. But the reality is today, we're a little over $700 million, or about $680 million when we did this graph. Today, we're actually a little over $700 million. So that suggests that the re-rate delivered a 23% lift in value for our shareholders as a result of putting these companies together and creating that critical mass, creating that scale, rising in relevance in the eyes of institutional investors who are looking for scale. They need liquidity in order to enter into a story. They need liquidity in order to capture profits in time as they exit. We've captured the imagination of the market because of the critical mass we've achieved, the scale we've achieved, and we think there's certainly we're poised for more of a re-rate as we rise in prominence on the indices, namely the GDXJ. As many of you recalled, when we did our IPO back in March, just within a couple of months of that, we became part of the GDXJ index. Since then, we acquired Ely, we acquired Golden Valley, we acquired Abitibi, and we effectively quadrupled our size and quadrupled our weighting on that index. That re-weighting actually doesn't happen until the end of November. At that point, there will be a significant influx of buying in the stock over the course of December to reflect that quadrupling of our weighting on the index. So just watch the space. I think this re-rating will be further enhanced as a result of that re-rating on the GDXJ index over the course of December. And then if you look at what happened with Ely, this shows you the re-rates that we've achieved on both of those transactions and compares ourselves against re-rates that have been achieved in other major transactions, M&A deals in the gold sector over the past few years. And we've been right at the top of the charts in terms of the re-rate we've achieved on the Ely transaction, which was about 37%, and in the case of Golden Valley and Abitibi, about 27%. So that's a significant lift. It really validates the investment thesis we undertook in doing these transactions. They're accretive to our shareholders. Most importantly, we've been able to demonstrate to our board and to the market that we've actually added value on a per share basis by putting our companies together. But again, by achieving that scale, we've achieved a re-rate for all of our shareholders, both the legacy gold royalty shareholders, but the new shareholders that have entrusted us with their capital. And again, thank you very much for voting for those transactions and becoming part of the gold royalty family. And with that, I think I'll hand it off to John to talk in a bit more detail through our portfolios.
Thanks very much, Dave. It's a tremendous pleasure to be speaking with you all today. And I think the aggregation of the four companies, starting off with Gold Royalty, then the acquisition of Ely, and then subsequently Golden Valley and Abitibi, we've ended up with a tremendously well-balanced portfolio which offers exposure to mines and projects that collectively have nearly 80 million ounces on a gold equivalency basis. The portfolio not only offers significant upside exposure to gold prices, but importantly also has a premium geopolitical risk profile, with nearly 3/4 of our underlying net asset value in the two best jurisdictions worldwide in which we operate, as noted by the Fraser Institute, namely Quebec and Nevada. Our 6 producing royalties will support near-term growth, while a further 7 are on assets in development that will drive growth in the next 3 to 5 years and beyond. We have an additional 29 royalties on feasibility or PEA and or resource stage projects that we believe will drive meaningful medium-term growth. Finally, we have nearly 150 royalties that offer long-term optionality and growth potential, 12 of which we believe to be key. Turning to slide 8 and talking a little bit more about Malartic in detail. As you noted in the video at the start of the town hall, head frame construction at Odyssey is underway, and we would note that it's on schedule and on budget. Completion of the head frame pour, commencement of the structural steel installation, and progress with the ramp development collectively highlight the ongoing advancement of the project. The ramp in particular is designed to support mining the upper zones of the Odyssey project and provide access for further underground exploration. Shaft sinking is expected to begin in the fourth quarter of 2022. Turning to slide 9, Agnico announced an update on exploration drilling at the Odyssey project on November the 2nd. Notably, this included recent underground drill results in the Odyssey internal zone and the Jupiter zone, which Agnico disclosed continued to demonstrate the potential to add mineral resources in close proximity to the Odyssey North and Odyssey South deposits. And the mineralization appears to be dipping to the north towards our 3% NSR coverage area. In addition, results on the easternmost hole at the East Gouldie deposit, which is trending east towards our 1.5% NSR over the Midway project, returned 4.8 meters at 6.3 grams per ton gold at a depth of just under 2,000 meters. This latest intercept is located approximately 750 to 1,000 meters away from the Midway royalty boundary. Turning to slide 10, Barrick is consolidating the northern trend of Goldstrike with the acquisition of Radio Creek and South Arturo, which lie to the northwest of Ren. Barrick recently commented that Ren itself represents a significant potential new discovery and is a key extension of Goldstrike. As a reminder, we hold a 1.5% NSR and a 3.5% NPI over the Ren project. Recent exploration results returned exceptional grades. For example, 12.8 meters at 26.4 grams per ton, located 130 meters west of an historic drill hole, which itself returned 45.7 meters at 32.54 grams per ton. Barrick highlights they're on track to deliver a maiden resource by year end, with the potential to contribute to life of mine plan in the short term. Advancement at the Banshee zone, just south of Ren, appears to trend towards the southern edge of our royalty coverage area. So we're really excited about having our own piece of Goldstrike, and this will be a major contributor to our cash flow and net asset value in the years to come. Turning to slide 11, on November the 9th, Wallbridge announced the much anticipated multi-million ounce maiden mineral resource estimate. And as a reminder, indicated resources of 2.13 million ounces, inferred resources of 1.47 million ounces, together totaling 3.6 million ounces. The resource is amenable to potential open pit and underground bulk mining, Importantly, there remains excellent growth potential of both open pit and underground resources, with such potential open in multiple directions and at depth. Also, there is known gold mineralization extending all the way to the Sunday Lake Deformation Zone, which can be seen in the graphic at the bottom right. We believe Fenelon will be able to support at least 200,000 ounces of annual production for in excess of 15 years, and we have a 2% NSR on this property. Turning to slide 12, in the approximate 9 months since completing the successful IPO, Gold Royalty has completed a major transformation with the acquisitions of Ely Gold Royalties in August and Golden Valley and Abitibi earlier this month. But we're excited to have a number of key catalysts to drive revenue, cash flow, and net asset value growth. I've already covered exciting news regarding Odyssey, Ren, and Fenelon, each of which will be a major contribution on its own merits. But additional near-term drivers also include Fortitude Gold's Isabella Pearl heap leach pad expansion, which is expected in early 2022. This pad expansion is expected to accommodate processing needs through 2024, with added flexibility for further expansion in the future. As well, Monarch's Beaufort mine and Beacon Mill are scheduled for restart in Q2 of 2022. We have a 1% NSR on the Beaufort mine and a Canadian $2.50 per ton royalty on the Beaufort Mill. And finally, the Jarrett Canyon mine, which is ramping up production and exploration activities under the new ownership of First Majestic, where we have a 0.5% NSR and a sliding scale per ton royalty. Turning to slide 13, I wanted to talk a little bit about our royalty generator model. Our ability to generate royalties via the royalty generator model sets us apart from our peers. In addition to having generated more than 35 royalties in the past, which, by the way, include Odyssey itself and also Isabella Pearl, continues to generate organic opportunities. It is singularly the most effective, cost-effective manner to acquire royalties, and some recent new examples include Barrick Gold, where they acquired an exploration stage project in Nevada, over which we have now a 2% NSR, representing an early stage transaction with a tier 1 operator. In addition, Eldorado Gold entered into an option agreement in the Abitibi region over several properties, providing royalties over those multiple properties. Eldorado is expanding its presence in the Abitibi region of Ontario and Quebec. And finally, Blackrock Silver, their Tonopah West project. In October, Blackrock announced significant exploration success at Tonopah West, as well as a strategic investment from First Majestic. And turning to slide 14, we're very proud to have a list of very high quality operating partners. It's a key consideration for us in evaluating new opportunities. As we share our ESG philosophy with our partners, it's particularly important for us as a royalty company, given the fact that we do not have direct operatorship of the mines. As a result, we pay particular attention during the due diligence phase to ESG considerations. Notably, we have turned down at least half a dozen investment opportunities due to ESG concerns, whether they be environmental, safety, or community related. We would note that in more than one instance, our competitors have acquired these assets, but we will not compromise our core ESG principles. And now I'd like to turn back to Dave.
Thanks, John. Just to wrap things up, I just wanted to highlight macro standpoint, the balance that we enjoy in our portfolio. First, we're metals focused, precious metals focused. You can see virtually 90% of our underlying royalty exposure comes from gold. And I think that's important because it's been demonstrated time and again, the companies that stay focused on precious metals on the royalty side tend to attract the best multiples, which drives down our cost of capital, makes us competitive to add, as we add new royalty opportunities into our portfolio and continue to grow. It creates a virtuous cycle. And you can see, though, while we're diversified across Americas, there's quite a concentration of our portfolio in Quebec and Nevada, which I think is a key competitive advantage relative to our peers, in that we're focused on the two best jurisdictions in the world, as measured by mineral potential, regulatory risk, and political risk. In other words, in those latter two criteria, those are the lowest risk jurisdictions in which to operate. And so the two most prolific gold districts in the world with the lowest risk from a standpoint of political and regulatory risk. And I think that's important, and again, distinguishes us qualitatively from our peers in the sector. But you can see the balance we have in our portfolio, and John alluded to this in his presentation, and I alluded to it a little earlier on. Almost half of our portfolio is in cash flowing or near cash flowing assets. And we have a significant amount of optionality in early stage opportunities right through to PEA and feasibility stage. So we have a very active pipeline. We have a lot of organic growth embedded in that portfolio that we've assembled over the course of this year, which again provides us that qualitative advantage relative to our peers. And where do we stand relative to our peers? Well, in very short order, from a standing start in March of this year when we launched our IPO, we've become one of the biggest companies in our tier, in the sub $1 billion market cap tier within the precious metal royalty and streaming space. We're certainly the most liquid, and this liquidity that you see, daily trading liquidity in the top right chart, actually understates what our trading liquidity today is. That's a 65-day average. If you've looked at how we've traded since we closed the Elite transaction at the end of August, in fact, we're trading at almost double that value, almost $5 million of trading per day. And again, that's a significant competitive advantage relative to our peers, many of whom have been in the space for 10 years, trying to build up the critical mass that we've been able to achieve in a matter of months. And it's again put us at the top end of this tier in terms of the number of royalties by quite a distance, 190 royalties, and the next is in the 120s, and the strongest balance sheet with just under $50 million in cash, no debt. Again, I think that distinguishes us as well. So we're in a very good position to continue to grow the business, tap into the treasury that you've entrusted us with in order to continue to grow value on a per share basis. And I think this is the reason why we've been able to accelerate our growth so rapidly, is the depth of our management and board. And I have to confess, and I'm embarrassed that we have one significant omission here. Jared Boffman should definitely be on here. He's the vice president of our Nevada business, and he's been doing this for a long time. He was Trey's partner in the founding of Ely Gold 10 years ago, but he's staked hundreds of claims that's resulted in over 100 royalties that we benefit from within the portfolio today. Jerry's an integral part of the senior management team within this group. But you can see beyond Jerry and Trey and myself, we have a group that has collectively over 400 years of experience in the mining sector, and many of us on the operating and mine development side. So we understand how operators think. We understand where their pressure points are. We understand when they need capital and the flexibility they require in order to build out their operations and deal with the underlying risk of building and developing mines. So that gives us a clear-eyed view of the risks associated with what they're doing, but also gives us access. Given the seniority of this team, this management, this board, it's given us really unprecedented access and unparalleled access to opportunities. Virtually everything we bought in bilateral negotiations. We haven't been in competitive processes. In fact, we've been in a few, we've lost them. And I wear that as a badge of honor, because I can assure you in those competitive processes, what was paid was well beyond what would be accretive on a net asset value per share basis. It would have been undisciplined for us to try to win those processes. We compete in them because it informs our processes. It tests out our criteria and our diligence. But at the end of the day, we're unlikely to be competitive in those processes because companies tend to overpay when the competition's hot. And having that access, that bilateral access in order to get at these opportunities before the marketplace is aware of them has been a key competitive advantage and has allowed us to grow quickly and accretively for our shareholders over the last several months. So this is the opportunity as we see it. to close that valuation gap that we see between the category killers in our space, the Francos, the Wheaton Precious Metals, and the Royal Golds that are typically trading upwards of 2 to 3 times the underlying net asset value of the business. And then the rest of us are all congregated around 0.9 to 1.25 times NAV. Closing that multiple gap is a huge opportunity for our shareholders, and achieving critical mass with a focus on per share value creation is really what's going to close that gap, and is a huge opportunity for a lift in valuation and lift in share price for our shareholders over the coming months and years as we continue to build our business out accretively. And so with that, we're right at the 30-minute mark. I wanted to make sure we left 30 minutes for Q&A. We'd be delighted to take questions, Mark. Mark, are you going to be shepherding us through the Q&A?
I will walk through that with great respect, David. Thank you very much to both you and John for that tour. And honestly, from this perspective, quite a lot. This has been an insanely busy year for the company. And I look back at our time with Ely and speaking with Trey in our town halls, and then it just continued with new business combinations. Congratulations on all the hard work. And I want to start with one quick point here, David, that you offered before we went live, which is the integration of some of the top talent that you found through these business combinations. Can you tell me a bit about some of the players and how they've integrated into your regular, I think you said, weekly gatherings to talk about growth and expansion of the business? That's a remarkable thing.
Well, the management meeting started as a small contained group. It was myself, Josephine, John, Alistair, and Peter Benke, who runs our investor relations and is an analyst in our corporate development group. And it's grown, but I'd say happily. We've invited Ely's founders, Trey and Jerry, into those management meetings in July, August, when we were getting close to closing that deal. And they've seamlessly integrated themselves into those weekly meetings and been very, very strong contributors in terms of ideas and some perspective on some of the ideas that other people are bringing to the table. Mm-hmm. And then as we were approaching the end of this transaction with Golden Valley and Abitibi, Ian Ball and Glenn Mullen joined our management meeting several weeks ago, and they've been incredible contributors. Glenn and Jerry in particular continue to do what they do, which is prospect. They stake exploration claims, they farm them out, they take royalties back, and they continue to do that even while we were in the midst of closing those transactions. And they're continuing to do that generative work that they've done so capably for decades. In Jerry's case in Nevada, with Trey's partnership, and in Glenn's case in Quebec and Ontario with Ian Ball at his side. So we're very, very fortunate to have seamlessly integrated those people into our organization, and they continue to do what they've done so well in terms of creating value for the shareholders.
Terrific, David. Thank you for that perspective. Congratulations. In some sectors, we say that's all the right people on the bus, I would say. So thank you for that. We want to move on to some great questions that are coming in from all points that from our audience. And let's start off with this question here, gentlemen. How do you plan to accelerate revenue generation? Is it through purchasing cash flowing royalties or mergers and acquisitions?
John, over to you.
Well, great. A great question. I think we've got a tremendous luxury, if you will, of having a portfolio, as I mentioned, that has got embedded in it tremendous organic growth. The 6 producing royalties themselves all have a key growth element. The 7 that are in development are going to provide growth from 3 to 5 years and beyond. So with that tremendous organic growth, I think Dave would not be happy if I sat on my hands and was inactive from a corporate development point of view.
Right.
So we will also be looking at acquisition opportunities, and we'll remain focused on assets across the spectrum, but certainly cash flowing assets would be at or near the top of our priority list. But we'll remain very disciplined about asset quality and about pursuing transactions that are going to be accretive to net asset value.
Terrific. Thank you very much for that, gentlemen. Moving on to the next question. Will Gold Royalty rather maintain its Americas and precious metals focus, or will it look to diversify in terms of geography and commodity mix, such as copper and battery metals?
Great question as well. And I think we have a tremendous endowment of geopolitical risk that is really the product of putting the 4 companies together. And it is somewhat by circumstance that that endowment happens to all be in the Americas. That doesn't mean we won't step out of the Americas. I think what it means is we have a tremendous platform from which to do so. As Dave mentioned, we have nearly 3/4 of our net asset value in the world's 2 primary jurisdictions. So our ability to absorb additional geopolitical risk is second to none. Again, I will repeat what I said in answering the first question, which is we will focus on asset quality and adding net asset value per share.
Terrific. Thank you for that very much, John. Question here from behind the scenes in terms of the company operations and strategy. How does the royalty generator model work? For example, how do Glenn and Jerry get the royalties, quote unquote, for free? Once this combination happens, how do things unfold so we have a better understanding?
Great question, and actually, it's a great example to go back and look at one of the transactions that I referenced in some of the comments I made, and that was the transaction we did with Barrick. So what Jerry will do is he'll go out and he'll stake claims in Nevada based on his knowledge. I don't think there's anyone who has as much knowledge about Nevada as Jerry does.
Right.
He'll stake those claims. Package them up, and then sell or lease those claims to an operating company. In this case, it was Barrick, and retain lease payments. So I think in that case, we will earn approximately $250,000, during which time Barrick will drill the property, exercise its rights, and we have a 2% royalty on the back of it. So it costs us just the human resources cost of having Jerry as part of our team, and the work that he does going out and staking these claims. There's no better way to create royalties from a point of view of value creation. And Glenn does exactly the same thing, but in Quebec and Ontario.
Mm-hmm. Very good. Thank you for that, John. Much appreciated. Next question we have here. What does the gold royalty team make of the Wallbridge MMRE at Fenelon? One might say it appears the market doesn't like it. Would you say it's below gold royalties expectations? So
I'm going to jump in, and John, obviously interject if you'd like. What I'd say is kind of an example of buy on rumor, sell on fact. It's certainly the market was buying, anticipating a resource update, and the stock had a nice run anticipating that, and it certainly met our expectations and many of the analysts' expectations in terms of scale of the resource. But of course, when you get into that point of the cycle, when you've announced the resource, then the mind turns and investors' minds turn to how it's going to be built out and the capital intensity, the operating costs profile. So I think the market is rightly focusing on, well, how do you bring this deposit to fruition, and what is the capital required? And I think that's not uncommon. It's a classic Lassonde curve. You buy anticipating the resource, and then as you start to get into the de-risking stage and putting that resource to productive use, the market starts to focus on the fundamental economics of the deposit, the capital required, et cetera. And so I think that's generally what's happened. But we were very, very pleased with the resource. Certainly met our expectations and highlighted the optionality embedded in that royalty that we were able to acquire as a result of the acquisition of Ely. John, anything you wanted to add to that?
Yeah, I think the only thing I'd add, Dave, is there's significantly more exploration potential. So I don't think we've seen the end of that. I think we have a little bit of a tiger by the tail, quite frankly.
Terrific. Thank you for that, gentlemen. I want to say this highlights why we enjoy these sessions where an audience can interact with those behind the company. We have Tim, who's a long-term investor, who just wanted us to convey to both David and John here that he greatly appreciates the current and future efforts and very much your detailed update in royalty investments. And a thanks very much. So we'll toss it out as a point of light here, gentlemen. It's why we do what we do here at the VID conference and town hall forums. Next question we have here. Can you tell us who are your top 5 shareholders and how many shares roughly do they own? Just to give us a perspective and a behind the scenes insight there.
Well, some of them I'll mention, and they're in the public domain. So Gold Mining, our founding shareholder, still owns about 14% of the company, and that's a long-term strategic investment for them. They're there for the long run, and they've been extremely supportive of us as we've grown out the business and allowed themselves to get diluted, which is a difficult thing for them to do because they provide us our foundational asset base of 17 royalties, but they recognize the importance of achieving that scale and diversity in our portfolio, and they've been extremely supportive of us. But as a result of the transactions we've done with Ely and Golden Valley and Abitibi, we've inherited Eric Sprott, Rob McEwen, among others. And management still owns a meaningful percentage, and board own a meaningful percentage of the outstanding stock as well. So we're definitely aligned with the interests of shareholders, given our foundational shareholdings within the founder group.
Terrific. Thank you for that, David. And I think you touched on this a little bit, but I'll ask this for good measure. Is there a special relationship between gold royalty and gold mining?
Well, there is, in that we actually have some cross-pollination of talent. We have Amir Adnani and the former CEO of gold mining on our board, Garnet Dawson, who's a geologist, and Amir, obviously a prolific entrepreneur on the mining side, and we're delighted to continue to have him on the board. Alistair Still, who is the current CEO of gold mining, is still our director of technical services at Gold Royalty, and he provides a wealth of experience. He's a geologist by training, but himself a very experienced mine operator, having operated in the Porcupine District in Ontario in a senior management position, and then was the project director on Cerro Negro in Argentina, the largest gold mine in Argentina that is now an important part of Newmont's portfolio. So we're very lucky to have him within the group that provide that expert counsel as we do due diligence on new opportunities.
Much appreciated. Thank you very much. Now, a little bit of throwback here, David, from our multiple town halls we had as Ely and Gold Royalty came together. We have someone here who is a Golden Valley shareholder asking, when do Golden Valley shareholders get their Gold Royalty shares due from the merger?
It should be there. Call your broker. If it isn't in your account, then they're not looking out for your interests as well as they should. So call your broker, please. It should be in your account by now.
Terrific. I appreciate that clarity as well. We also want to check in and just your intentions here, gentlemen. Do you intend to generate significant dividend income to shareholders? What would your viewpoint be on that?
Look, what I would say is that royalty and streaming companies are effectively annuities. We buy annuities on long life mines with significant geological upside. And so if our underlying business is a collection of annuities on these assets, then our shareholders should expect an annuity as well. And so as we integrate these businesses and create that critical mass, both in terms of the diversity of our portfolio, but also in terms of our cash flow, which is growing quite significantly, we will have a dividend in due course. And given that we've only started in March, we haven't actually had an opportunity to sit down and do a budget and a strategy document with our board, integrating all of these businesses together. We're doing that in December. We're getting together with our board physically for the first time, in this COVID world, or hopefully post-COVID world. And we'll start to map out 5-year plans and talk about dividend policy, when to introduce a dividend. But I think it's an intrinsic part of an integral part, I should say, of any royalty and streaming story to have a dividend. So please watch this space.
I appreciate that very much. Now, I do recall from our previous town halls as well, David, there's really tax advisement is not part of the energy here in these sessions, but I do want to honor that somebody's put forward a question for you, and I'll let you respond to this. That any likelihood that U.S. owners of Ely Gold will get tax-free exchange rather than sale and purchase, forcing capital gains to the IRS? Is there something they need from Gold Royalty, or can they deal with that with the U.S. broker like a TD Ameritrade or whoever they're working with?
Look, I think your first call should be to your tax accountant. And then if you need something from us, please don't hesitate to call us, and we'll help you any way we can.
Terrific. Thank you for that clarity as well, David. For an open question here for both of you gentlemen, looking back at quite the remarkable transactions and evolution inside the company, let's look ahead a little bit. I think people in the audience always like to get an inside view of, a 3, 6, 12-month timeline. What are the markers on the calendar that we should be watching for as we watch the stock and the evolution of the company?
Well, John alluded to that, and I'll let him refer back to some of the catalysts we have coming in the story. John, please.
Yeah, I think firstly on the asset side, the 3 key assets where I think there's going to be tremendous excitement. Each asset on its own is going to be a tremendous driver of value and cash flow growth in the company. That would be Odyssey, Ren, and Fenelon. So I'd watch very closely on how those 3 projects progress. And then in addition to that, as I mentioned, we've got additional growth catalysts, which we can certainly expect to add significantly to our as I said, 3 to 5 year growth horizon.
Mm-hmm.
And then, you know, I did say this, and I don't mean it just tongue in cheek, but Dave is not going to allow me to sit on my hands from a strategic standpoint. We do have, what I can tell you is we've looked at nearly 100 opportunities since we were formed. So if you think about that, as a young company, we've been very, very active. And I can tell you that there are certainly a number of files that remain open. We hope that in the fullness of time, we'll be able to execute on some of those transactions. So M&A is definitely part of our agenda as well. And I don't just mean consolidation. I mean adding, you know, other additional high quality assets that I think will be very exciting growth drivers for the company going forward.
Oh, terrific. Thank you very much for that. Another question's come in here, gentlemen. You noted revenue is forecast to increase, but do you foresee general, administrative, and other costs increasing in line with revenue?
I think we have everybody we need on the team to grow our business exponentially. I think we could grow our business tenfold with the group that we have already in place. I don't see our G&A costs going up significantly. In fact, the majority of our G&A costs is liability insurance associated with being listed in the US. And so our cash G&A is actually smaller than our insurance premiums. So, you know, we keep a very small G&A footprint, and that's the beauty of our business, how scalable it is with a very small human footprint.
Terrific. Thank you for that. I always like to ask this question of those that have built a company such as yours, David. When you drive home at night, there's so much has changed in the last year for the company. What's your most exciting thought process as you continue to lead this company? You've got these people from other companies that have joined you with the combinations. It changes the DNA, it changes the energy of the vision and the trajectory of a company. What gets you most excited?
Well, look, first off, nobody's driving home these days or working from home. But that being said, what I would say is that to me, what excites me is working with the people that we've assembled. I'm as excited, if not more excited, about the team we've curated, not just the asset base, because I know assets come and go. We can get more assets. It's getting the people that actually gives us access to those opportunities. And I talked about it again, the access we get from the collective experience, the seniority of our team is such a huge advantage relative to our peers. That's why in the course of months, we've grown a business to the scale that our peers have taken 10 years to achieve or haven't even achieved after 10 years. And so I think that speaks to the people and the expertise we're able to leverage from those people. Working with those people every single day is what excites me. And these are people that I've surrounded myself with, that I have a deep level of trust with, that I've worked with for decades in many cases, John included. John's been a trusted advisor of mine for a very, very long time as an investment banker, and I knew that he would just flourish in this opportunity, and I was glad to be able to attract him. But that's true of really, if you look at all of our team, I'm very excited about each and every one of those individuals and working with them every day.
Beautiful. Thank you. And as always, I like, as we turn our focus, we're getting closer to the top of the hour here, gentlemen. Some great questions from the audience. Fantastic presentation. The video gave us a wonderful bird's eye view of your flagship operation. I want to ask and leave this open for you. Anything we haven't touched on? You know, investors are watching and listening at this point. We all need informed decisions on a day-to-day basis. What have we missed, or what else are you called to share with our audience today? You know, the one thing that maybe I can emphasize is the investment case for gold. And I probably didn't talk about that. I talked about where you should be if you believe in a rising gold price environment. I really firmly believe that you should be in the royalty and streaming business, which is why after 30 years of operating and building mines, I positioned myself at this point in my career in the royalty and streaming business. I really believe it's poised for outperformance as the industry reinvests back into the ground. But I would say that gold has the potential to move up violently. And we've seen some pronounced increases in CPI, which I think actually significantly understates the CPI we're all experiencing. I mean, the basket they use for headline CPI numbers is patently ridiculous. Unless you're buying fuel, putting food in your stomach, or putting a roof over your head, you're not realizing 6% inflation, realizing well into the double-digit territory. Gold has always been an accurate barometer of that inflation. And up to this point, it's maybe understated that inflation, but I think there's going to be a catch-up trade in gold.
I believe gold goes to $3,000 an ounce, which is the real all-time high. And while there's some concern about interest rates going up, what I would say is, yes, nominal interest rates are likely to go up nominally over the foreseeable future. I think you're going to start to see a tightening cycle by the Federal Reserve, the Canadian Central Bank, the European Central Banks, but that's nominal rates because inflation will continue to gallop. Real rates will continue to go decidedly into negative territory. It'll continue to go down, and that's really a barometer of what's going to happen to the gold price. So if you have real interest rates decidedly negative territory and going deeper and deeper negative territory as nominal rates go up, gold will do extremely well. And gold does not go up, nor do commodities generally go up in a nice, steady, straight line. What happens is the reaction in the marketplace tends to be an oh my God moment and a violent upward reaction in the gold price. So when we get to 3,000, it won't happen in a matter of months or years. It'll be a violent reaction upwards, and I think it's imminent.
That spike energy, absolutely. Very much appreciate that, David. And obviously, you know the industry and the sector, so I appreciate the insight. Both you and John, I want to say thank you on behalf of our audience for being part of the VID brand. It's always great to have a roundtable discussion with you. This is why we do what we do, to bring an audience to the company and hear directly from the source. So I think you've done a fantastic job today. I want to thank both John Griffith and David Garofalo from Gold Royalty. And I know that we'll see you again because this is always a great winner for our brand. Thanks very much for your time.
Thank you.
Thank you very much.
Absolutely. To everyone else joining us, thank you for the questions and being invested in your investments. I wish you the very best from here. My name is Mark Johnston. Thank you for joining the VID brand and a wonderful tour with Gold Royalty. We'll see you again. All the best.